Today we're cracking open the Economist's toolkit. We're going to see exactly how policymakers use these simple but really powerful graphs to diagnose a sick economy and then prescribe a cure. We'll walk through a real-world style problem to see these tools in action. Okay, let's dive right in. What you're looking at here is called a Phillips curve. It shows the relationship between inflation and unemployment for a hypothetical country we'll call Barricos. And right now, this graph is telling us Barricos is in a bit of trouble. Let's break down what's really happening.
So before we can fix anything, right, we need a proper diagnosis. It's kind of like a doctor checking vital signs. An economist looks at the key numbers to really understand the health of the economy.
See that little dot, point X? That tells us everything we need to know. The actual unemployment rate is at a super high 10%, which is way above the 4% that economists consider natural or healthy for this economy. At the same time, actual inflation is down at 3%, which is lower than the 5% everyone was expecting. So, high unemployment and lower than expected inflation? Yep, that is the classic sign of a recessionary gap.
So what can be done? Well, the first toolkit belongs to the government. It's called fiscal policy, and it's all about using the national budget to influence the economy.
The core problem here is that unemployment is just too high. That means people aren't working, they're not spending, the economy's kinda stuck. So the government needs to find a way to jumpstart all that economic activity. What are its options? The government has three main levers it can pull. It can spend more money directly, on things like roads or schools. It can cut taxes, which leaves more money in our pockets to spend. Or it can increase transfer payments, like unemployment benefits. All three of these are designed to do one thing: boost overall spending in the economy, or what economists call aggregate demand. Okay, so here we are again, back at point X. We've got our problem clearly defined on the graph, a whopping 10% unemployment. Now let's apply one of those fiscal policy tools and see what happens.
And boom, this illustrates the short-run effect perfectly. By increasing spending or cutting taxes, the government stimulates the economy, and we move along the curve from point X to point Z. The good news? Unemployment falls. But, and this is a big but, notice we don't get a free lunch here. To get that lower unemployment, we have to accept slightly higher inflation. That, my friends, is the classic Phillips curve trade-off.
But hold on, that's not the end of the story. In economics, every single action has a reaction. So, the really crucial part is understanding the ripple effects of this government stimulus. Think about it. To pay for this stimulus, the government has to borrow money, usually by selling bonds. This creates a budget deficit, and that borrowing kicks off a whole new chain of events in the financial markets. All right, now let's see how this all connects. On the left is the problem we just solved on the Phillips curve. On the right, we've got a new graph, the market for loanable funds. This is basically where saving and borrowing happens, and the government's actions are about to make a pretty big splash. See that shift? That's the government jumping into the market to borrow money. That increases the total demand for loanable funds, shifting that demand curve to the right. And when demand for anything goes up, what happens to its price? It goes up too. In this market, the price of borrowing is the real interest rate, and we see it rise from R1 to R2. Now this is where things get really interesting, because this change doesn't just stay within Barricos' borders. Those higher interest rates, they act like a giant magnet for global money. Investors all over the world see they can get a better return in Barricos, so they start moving their cash into the country. And to buy those assets, what do foreign investors need first? They need to buy Barricos currency. So you get this sudden spike in demand for the currency, which makes it more valuable or stronger compared to other currencies. In other words, it appreciates. So think about that for a second. The policy to fix unemployment on Main Street ended up making the nation's currency stronger on the world stage. Wild, right? Okay, let's put the government's toolkit aside for a minute and pick up a completely different one. This one belongs to the central bank, and it's called monetary policy. But here's the thing. Something huge has changed recently in how central banks, like the U.S. Federal Reserve, actually do their jobs. As the St. Louis Fed explains it, the entire playbook has changed. Central banks used to operate in a limited reserves world. They'd have to buy and sell government bonds to just kind of nudge the money supply. Now we're in what's called an ample reserves world, where they use a much more direct tool, just changing the interest rates they control. This is the new reality. The banking system is just flooded with reserves, so adding or removing a little bit doesn't really do anything to interest rates anymore.
Instead, the central bank, like the Fed, uses a powerful tool called interest on reserve balances. By changing the interest rate it pays commercial banks just to hold money with it, it can directly steer the main policy rate for the entire economy.
So let's see this new tool in action, shall we? Imagine our economy has recovered, and now the central bank is getting a little worried about inflation getting too high. In this new world, what does it do?
This is a graph of the reserve market. Notice how that vertical supply of reserves is way over on the right? It's intersecting the demand curve in that flat horizontal part. That is what ample reserves looks like on a graph. The policy rate is sitting at PR1.
And here's the move. It's so clean. The central bank doesn't touch the money supply at all. Nope. Instead, it just announces that it's raising its administrated rates, like the interest it pays on reserves. This action literally pulls the entire flat part of the demand curve up, which directly raises the market policy rate from PR1 to PR2. It's a much more direct, almost surgical way to control interest rates.
So we've seen fiscal policy and we've seen monetary policy. Let's zoom out for a second to see how economists actually calculate the impact of these decisions.
You know, policymakers can't just guess. They need to know how big of a policy change is needed to get the result they want. They use something called a multiplier. This question is a great example. If we need to cool the economy down by 400 million, how much does the government actually need to cut its own spending? The answer is just 100 million. And you might be asking why. Well, it's all because of something called the spending multiplier effect. When the government cuts its spending by 100 million, that money is taken out of the economy. But that's just a start. The people who would have received it now cut their spending, and so on down the line. In this case, every 1 rupee cut in government spending leads to a 4 rupee drop in the total GDP.
So what's the big takeaway here? The really crucial point is that these graphs aren't just academic exercises. They are powerful, interconnected models that show us how a fiscal policy action creates these predictable ripple effects through financial and global markets, and how modern central banks have completely changed their game to manage the economy more directly.
And this all leaves us with one final big question. We have 2 powerful but very different toolkits to manage the economy. One is controlled by politicians, the other by independent central bankers. So when a crisis hits, who should be the first responder? That's the debate policymakers are having every single day.